Hi everyone. Today's topic for education is mutual fund versus PMS investments in India. So the agenda for this video is to take you through the characteristics of mutual funds and PMS and what impact does net asset value of the fund have on mutual fund and PMS. So this slide talks about comparison of mutual funds and PMS. I would like to take you through three points which gives you the main comparison of mutual fund and PMS. The first point being restrictions from regulatory authorities. We see that mutual funds are restricted quite a lot in comparison with PMS by regulatory authorities, in this case SEBI. So the main restriction being a mutual fund house cannot invest more than 10% in a particular company. This ties the hands of mutual fund manager to invest in securities at a concentrated level. Coming to PMS, the PMS manager is not restricted in investing into listed space. So he has full discretion in investing whatever percent of the total portfolio in a particular company. The second point being tax benefits. So mutual funds typically have a tax exemption in terms of portfolio churning, which PMS fund doesn't have. So in simple terms, the tax benefit for mutual fund is, suppose you invest 100 rupees in a mutual fund, and after a couple of years, that 100 rupees had increased its value from to 150. Now, during this 1.5 year period, any changes the fund manager had done within the mutual fund portfolio, that is buy or sell securities, the gain or losses arising due to such buy or sell transaction would not be taxed in the hands of the investor. Only at the time of redemption, which is if you redeem the 150 rupees from the mutual funds, you will be taxed at a gain of 50 rupees from the previous invested amount of 100 rupees. However, this particular exemption is not available in a PMS fund. So in case of a PMS, if you invest that same 100 rupees in a PMS fund and the PMS fund manager buys or sells securities within the fund, the investor would be liable to pay taxes on any gains which might have been arised due to such buy or sell transaction. The third point I would like to highlight here is the portfolio concentration. Since in mutual funds, the fund manager is restricted in having more than 10% weightage in a single stock, we typically see that the mutual fund portfolio is much diversified and in sync with the index, which is not the case in PMS fund. Since PMS fund is at the discretion of the fund manager, the fund manager can have any sort of weights in any companies within its portfolio. This would result in a typically higher concentrated fund for a PMS house. Due to this major difference in terms of concentration, we see that the expected return for a mutual fund house would be slightly in line with the index as a whole. However, in case of PMS, since the concentration is really high, the odds of having a higher return in a PMS fund is better compared to your mutual fund. So the second slide talks about the importance of net asset value in mutual fund and PMS. So here I would like to take you through a small example where Mr. A invests 100 rupees in mutual fund and PMS at the same time. So let's see what impact does mutual fund and PMS have on those investments. So when Mr. A invests 100 rupees in mutual fund, and after such investment, there is a market correction of 30%. This would reduce his investment value from 100 to 70 due to such market correction. However, since the mutual fund manages the investment at a pool level, there might be a situation where the other investors within the mutual fund would panic due to such correction, and this would create a sell pressure within the fund. What this means is the investors within the fund would put on redemption requests, and the mutual fund manager, in order to fulfill those redemption requests, will in turn sell the underlying securities of the fund. Now, due to such sale of underlying securities, the value of the fund put together might further deteriorate from the level of 70 to the level of 50. Now, the investment of Mr. A, which stood at 100, had reduced to 70 because of market correction and further deteriorated to 50 due to the sale pressure created by the other investors, which is not the fault of Mr. A. However, if we compare the same situation with the PMS investment, where Mr. A invests 100 rupees within the PMS fund, and due to market correction, the value of Mr. A went down from 100 to 70. Now, in PMS fund, the investment of Mr. A is maintained separately and independently of the other investors within the fund. This means that the investment decisions of the other investors within the PMS fund would have a less impact on the investment of Mr. A. So the investment of 100 would drop down to only 70 level due to the market correction, and more or less stay at 70 level irrespective of what decisions were taken by the other investors within the fund. So in conclusion, I would like to run you through 3 points in this particular slide. So in India, while the investments in mutual funds make sense because of the tax exemptions which they come with, we cannot overlook the fact that there is a downside risk because of pool level investment, as we have seen in slide above. In terms of PMS, since the accounts are maintained separately and independent of each other, this may result in a less impact of other investors' decisions for the investor in a stressed market. With this, we can conclude that there are higher chances of making a better return in a PMS fund when compared to the mutual fund. That's it for this video. Thank you.